Hi there, everyone, and welcome into this week's market update. Now, don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself what is appropriate to you. Okay, as usual, start with the XJO. Now, you can see the XJO is currently in a bit of a downward trend at the moment. We've got lower peaks, lower troughs. We've come off a double top here at 71.42. We've almost fulfilled that double top at the moment. It's sitting at that next level of support around here at 6,800 thereabouts. If we clear through this support level, 66 is the key target on the downside. After that, 6,400 represents a 10% correction from where we were up at 71.42. 66 is a key reflection point. If you come back in time, a few years here, you can see around about that 6,600 level, guys. We spent a lot of time around here on that COVID recovery, and that I think we spent a good 4 or 5 months there. And then also back before COVID, we spent quite a few months hovering around that 66 level. So it is a key reflection point for our market. And it seems logical to me that we could head down and test that level given everything we're seeing around us at the moment. So let's get across to the US market. So the US was actually closed last night. So this is reflecting what happened on Friday. So basically at the moment, they're also in a downward momentum back to the next key level of support around 39 here. A break of 39 brings them probably back to around 37.30 here. That's the next level of support. After that, you've got 36.37, okay, which is the lowest price they've traded to. You might as well call it 36.50 thereabouts, okay. It's the lowest point they've traded to this year. And once again, I've been saying this for a while, I would not be surprised to see our markets back down to those levels. Okay. At this point, I think the jury is still out on whether we'll break through or not. I think we'll hold. Okay, but I do think we should be back at those levels. Okay, given the current pace of interest rate hikes and the fact that they're still likely to keep going at the current pace, we still haven't really seen the inflation story come to an end. So there's quite a bit going on out there. This month is particularly a bearish month seasonally. Plus, we've got quite a big break since the last time the Fed actually lifted rates. So it was almost by the time they announced at the end of September, it was 7 weeks ago. Okay, so it's a long time between the two rate announcements for the Fed, and the question is, are they going to go hard again this time round? So, look, with all that playing out throughout September, once again, I wouldn't be surprised to see it's quite a bit lower than this. Okay, they are oversold. Okay, so we could see another retest of 4,000 tonight when they reopen after a long weekend. The futures at this point are indicating a slightly higher open, about 5 or 6 points. So it's not really giving us much of a lead at this point of time. So we'll just have to see what we wake up to tomorrow morning. But yeah, look, at this point in time, I think a retest of 4,000, but ultimately down towards 36.50 is what we're looking at in the coming weeks. Okay, so let's broadly talk about what's going on out there. So over the weekend, we saw Russia cut off gas to Europe through a key pipeline indefinitely. Okay, so that's causing a bit more of a cloudy outlook for that and a resolution to the energy crisis out there. And what we're looking for is for this to ease off so that way inflation can come back down. One of the biggest contributors to inflation is energy pricing over in Europe. We saw European CPI rise again last week. We'll likely see the ECB later this week increase rates again to try and fight off demand, okay, as the Fed is and other central banks of the world. This just adds fuel to the fire, guys. And then on top of that, we saw OPEC cut production. Okay, we want them to be lifting production to help fix this energy crisis, help fix this inflation crisis. And the inflation crisis has been caused, as you know, we've been talking about this for the last 8 months. It's been caused by a combination of things. It's obviously a lot of stimulus being splashed around after COVID, so pretty big jump in demand all of a sudden happened late last year, early this year. That was the first push of inflation. And then Russia invading Ukraine just made the situation a lot worse. So what we need is a resolution now of what's happening in Russia and Ukraine. We need a resolution to this energy crisis around the world, because it's not just Europe. Okay, we're seeing energy crisis around the world. So we need to see prices come back down in energy so inflation can ease off. The longer energy prices continue to rise and elevate, the longer it's going to take to bring inflation back down to the central bank's target, and the more they're going to have to lift rates to try and make that happen. The more they lift rates, the more we're going to head towards a harder landing. And that's kind of what markets are reacting to right now, just to trying to summarize it up as quickly as possible. So, there's more to it, obviously, than energy. Obviously, there's labor prices going up and things like that for businesses. Wages are increasing, but nowhere near to the rate of inflation. So there's something else going on out there, guys. It's not a simple thing to talk about. There's a lot of factors at play that's causing inflation to go higher. But one of the biggest factors, in my view, is this energy crisis. And if you can bring energy prices down, you're going to see price relief across the board. So that will quickly bring the CPI back towards the central bank targets. Okay, so at RBA, that lifted rates again today by another 0.5%. Huge. That's crazy. That's 3 in a row at 0.5%, guys. We've gone from near zero to 2.35%. Huge increase, and they're flagging more to come. Okay, so rates, wouldn't be surprised to see the RBA get up above 3%. Right, that means that mortgage variable rates, we're going to be looking at 5% plus, which has not been seen on the market for a very long time. This is if I keep going at this rate, guys, look, it's not going to be good, right? It's just there's nothing good that can come from rates going up this quickly. So my view at the moment is still bearish on the market. What I don't know, guys, is is this priced in yet? Like, that's always the question we ask on the way down in a bearish market. Is it priced in yet? Is it priced in yet? Is it priced in yet? We don't know, right? Nobody knows. That's why you use a combination of technical and fundamental analysis to try and find the bottom of markets. Okay, we don't know what we don't know. What I will say is the momentum's down on the market. That's likely not going to change until we actually see some kind of resolution out there for this inflation and interest rate problem. Okay, and we're not seeing that yet. All we're hearing from central bankers is that rates are going to go up further. So the next big key piece of the puzzle, right, and this is major, is the CPI reading next Tuesday night. This is key, guys. If CPI goes up more than expected, markets are going to tumble, right? If it comes in quite a bit lower, markets are going to go for a nice little rally. What CPI does next really dictates how aggressive the Fed's going to go at their rate announcement the week after. All right, so you got Tuesday next week, the CPI reading in the US. The Fed is going to be the Wednesday night, the week after. And that's key for September and how the market's going to move for the rest of this month. Okay. Now, if you want a clue on whether things are getting risky out there or not, you need to be looking at the bond yields in the US. In particular, I look at the 1 year and the 10 year, or the 2 year and the 10 year. And if they're rapidly rising, that's risk for the market. That means the market is getting dangerous. The market will start pricing in higher interest rates. Equities will fall. Okay, that's one thing. The other thing is energy prices. If crude jumps back above 100 and keeps lifting higher and higher, inflation expectations are going to increase. That's going to put added pressure on interest rates. So they're the two major things I'm looking at the moment, is if energy prices are increasing and if bond yields are increasing, or one or the other are increasing, that is added bearish risk to the market. So keep an eye on those 2 or 3 things, guys. Okay, because that's where the real information's at on the short-term direction of this market. So Fed's set to raise, guys. End of September. So we're talking a couple of weeks from now, not next Wednesday, Wednesday after. Pretty sure it's 22nd. Set to raise rates. There's no doubting they're going to raise rates. The question is it going to be 0.5% or is it going to be 0.75%? Because you're going to remember they haven't met for 7 weeks. At Jackson's Hole, Jay Powell and his team were talking very hawkish once again. Need to bring inflation down. And at what cost to the economy, we are yet to know. What we do know is the US has had 2 negative quarters of GDP growth. Okay, they're not calling it a recession yet in the US. They're not calling it an official recession because the job numbers are still very strong and there's some other strong economic data out there. I will raise the question on how long that economic data is going to remain strong if they continue to front load interest rates like this for the rest of the year. Okay, so bond markets are indicating the Fed could go all the way up to 4% now. Okay, which is huge. Okay, huge. All right, so that's where we're at. Things for me are still looking a little bit bearish out there, although we're now coming into an oversold condition. So at any moment we can see some sort of buying come back in the short term. There's a lot of debate on whether rallies at the moment are a bear market rally or not. To me, this is a big bottoming, right? I think this is going to be a big long-term bottoming. It's going to take 3 to 6 months to actually bottom out. It's going to be a huge W type pattern, a huge channel down here for a long period of time until this problem fixes itself. I think most of the selling's there. I think there's a lot of cheap stocks. Every time the market comes down near its lows, I think there's a lot of cheap stocks on the market. Therefore, I think we're finding a solid base. But if you think we're going to get a V-shaped recovery like what we saw out of COVID, think again, that's going to take a while to happen. The V-shaped recovery came out of COVID because of all the stimulus money, the low interest rates. We've now got the opposite happening. So it's going to take a while for this to bottom out and fix itself. We need to see the central banks of the world become dovish. We need to see a resolution to this energy crisis because for the central banks to be able to stimulate again, we need to solve the supply chain and inflation problem. Because if you try and strengthen the economy right now, we're just going to have the same problem again of inflation. So we need to solve the whole energy crisis and supply chain problem before we can boost the economy again. Okay, this is going to take a while to play out, guys. This means likely downward to sideways movement for a bit here before we start seeing really big recoveries back to all-time highs and things like that. All right, I'll leave it there. Thanks for listening in this week. Take care and bye for now.